Hey learners, welcome back to Edu Intern Voyage. Your learning journey starts. If you are a BCom student who wants simple, clear, and reliable study content, subscribe to Edu Intern Voyage, like the videos, and start your learning journey today.
Describe the listing formalities of securities and explain the importance of listing. 10 mark. Introduction. Listing of securities refers to the inclusion of a company's securities in the official list of a recognized stock exchange. After listing, securities can be freely bought and sold in the secondary market. Listing ensures transparency, investor protection, and smooth functioning of the capital market. Listing formalities of securities. To get its securities listed on a stock exchange, a company must comply with the following formalities. Application for a listing. The company must submit a formal application to the stock exchange in the prescribed form along with a listing fee. Submission of prospectus. A copy of the prospectus or offer document approved by SEBI must be submitted to the stock exchange. Memorandum and Articles of Association. The company has to submit certified copies of its Memorandum of Association, MOA, and Articles of Association, AOA. Minimum public subscription. The company must ensure minimum public subscription as prescribed by SEBI and the stock exchange. Allotment of securities. Securities must be allotted to investors as per SEBI guidelines, and details of allotment should be submitted. Dematerialization of securities. Securities should be issued in demat form and admitted with depositories like NSDL and CDSL. Payment of listing fees. The company must pay initial and annual listing fees to the stock exchange. Compliance with listing agreement. The company must agree to comply with the listing agreement and continuous disclosure requirements. Importance of listing. Provides liquidity. Listing enables investors to buy and sell securities easily in the stock market. Fair price discovery. Prices are determined through demand and supply, ensuring fair valuation of securities. Investor protection. Listed companies must follow SEBI and stock exchange regulations, protecting investor interests. Enhances marketability. Listed securities are more attractive and acceptable to investors. Public confidence. Listing increases credibility and trust among investors. Easy access to capital. Listed companies can raise additional funds easily through further issues. Economic development. Listing promotes capital formation and contributes to economic growth. Conclusion. Listing of securities is essential for an efficient and transparent capital market. By fulfilling listing formalities, companies gain access to wider investor participation, while investors benefit from liquidity, safety, and fair pricing. Discuss the role of financial institutions in India. 10 mark. Introduction. Financial institutions are organizations that provide financial services such as mobilizing savings, providing credit, and facilitating investment. In India, financial institutions play a crucial role in promoting economic growth, industrial development, and financial stability by channelizing funds from surplus units to deficit units. Role of financial institutions in India. Mobilization of savings. Financial institutions encourage people to save by offering various deposit and investment schemes. These savings are pooled and made available for productive purposes. Provision of credit. They provide short-term, medium-term, and long-term loans to agriculture, industry, trade, and services, supporting business expansion and development. Promotion of industrial development. Development financial institutions like IDBI and SIDBI support industries by providing finance, technical assistance, and consultancy services. Support to small and medium enterprises, SMEs. Institutions such as SIDBI provide financial assistance to MSMEs, encouraging entrepreneurship and employment generation. Development of capital markets. Financial institutions invest in securities and promote new issues, contributing to the growth of capital markets. Balanced regional development. By financing projects in backward and rural areas, financial institutions help reduce regional imbalances. Agricultural development. Institutions like NABARD provide credit and support to agriculture and rural development. Foreign trade promotion. Exim Bank provides financial assistance for exports and imports, strengthening India's international trade. Employment generation. By funding industries and infrastructure projects, financial institutions help create employment opportunities. Financial stability and economic growth. They help maintain stability in the financial system and contribute to sustained economic development. Conclusion. Financial institutions play a vital role in the Indian economy by mobilizing savings, providing credit, and supporting development across various sectors. Their contribution is essential for inclusive growth, financial stability, and overall economic progress. Explain the operations of the primary market. 10 mark. Introduction. The primary market is a segment of the capital market where new securities are issued for the first time to raise fresh capital. Through the primary market, companies, governments, and public sector undertakings obtain long-term funds directly from investors. It plays a vital role in capital formation and economic development. Operations of the primary market. The operations of the primary market involve the following stages. 1. Decision to raise capital. A company identifies the need for funds to expand business, start new projects, or meet long-term requirements and decides to raise capital through the issue of securities. 2. Appointment of intermediaries. The issuing company appoints intermediaries such as merchant bankers, underwriters, brokers, registrars, and bankers to manage the issue efficiently. 3. Preparation of prospectus. A prospectus is prepared containing details about the company, objectives of the issue, financial position, risk factors, and terms of the issue. This ensures transparency and investor awareness. 4. Approval from SEBI. The issue must comply with SEBI guidelines. SEBI examines the prospectus to protect investor interests and ensure fair disclosure. 5. Marketing of securities. Securities are marketed to the public through advertisements, roadshows, and brokers to attract investors. 6. Subscription of securities. Investors apply for shares or debentures by submitting application forms along with the required payment. 7. Allotment of securities. After the issue closes, securities are allotted to investors. In case of oversubscription, allotment is done on a proportionate basis. 8. Refund of excess money. Excess application money, if any, is refunded to investors. 9. Issue of share certificates/credit to demat accounts. Securities are issued in electronic form and credited to investors' demat accounts through depositories. 10. Listing on stock exchange. After allotment, securities are listed on a recognized stock exchange, enabling trading in the secondary market. Conclusion. The primary market facilitates the mobilization of long-term funds and promotes capital formation. Its well-defined operations ensure transparency, investor protection, and smooth flow of funds from investors to issuers, contributing to economic growth. State any 2 roles of the financial system in economic development. 10 mark. 1. Mobilization of savings. One of the most significant roles of the financial system is the mobilization of savings from individuals and institutions. People save money in banks, insurance companies, mutual funds, and other financial institutions. These scattered savings are pooled together and made available for productive investment. By offering various financial instruments such as savings accounts, fixed deposits, shares, and bonds, the financial system encourages people to save more. Higher savings lead to increased investment in industries, infrastructure, and businesses, which ultimately contributes to capital formation and economic growth. 2. Promotion of investment and capital formation. The financial system plays a vital role in channelizing funds into productive investments. Financial institutions like banks and development financial institutions provide loans and credit to industries, agriculture, trade, and small businesses. Well-developed financial markets ensure that funds are allocated to the most efficient and profitable sectors of the economy. This promotes industrial growth, employment generation, and technological development. As a result, capital formation increases, leading to overall economic development of the country. Examine the structure and functioning of the money market in India. 10 mark. Introduction. The money market is a vital segment of the financial system that deals with short-term funds having a maturity of up to 1 year. The Indian money market plays an important role in maintaining liquidity, monetary stability, and efficient allocation of short-term resources. It is regulated mainly by the Reserve Bank of India, RBI. Structure of the Indian money market. The structure of the Indian money market can be divided into 2 main sectors. 1. Organized sector. This sector is regulated by the RBI and includes the following institutions. Reserve Bank of India, RBI Apex Authority controlling credit and liquidity. Commercial banks, major participants providing short-term loans and deposits. Cooperative banks, provide funds mainly to agriculture and small borrowers. Development financial institutions, participate to a limited extent in short-term lending. Mutual funds and NBFCs, invest in money market instruments. 2. Unorganized sector. This sector is not directly regulated by the RBI and includes money lenders, indigenous bankers, chit funds and finance companies. Although its importance has declined, it still serves rural and small borrowers. Functioning of the Indian money market. The functioning of the money market is carried out through various money market instruments and mechanisms. 1. Call and notice money market. It deals with very short-term funds, overnight to 14 days. Banks and financial institutions participate to manage liquidity. 2. Treasury bills. Short-term securities issued by the Government of India with maturities of 91 days, 182 days, and 364 days. 3. Commercial bills. Bills of exchange arising out of genuine trade transactions and discounted by banks. 4. Commercial paper. Unsecured short-term instruments issued by financially strong companies to raise working capital. 5. Certificates of deposit. Negotiable instruments issued by banks to mobilize short-term funds. 6. Role of RBI. The RBI regulates the money market through repo and reverse repo operations, open market operations, and bank rate policy to control liquidity and interest rates. Conclusion. The Indian money market has developed significantly with improved instruments, institutions, and RBI regulation. A well-organized money market ensures adequate liquidity, effective monetary policy implementation, and overall financial stability, thereby supporting economic growth. Describe the various financial instruments in the capital market. 10. Market. Introduction. The capital market is a segment of the financial market that deals with long-term funds required by businesses and the government. It provides a platform for mobilizing savings and channelizing them into productive investments. Financial instruments traded in the capital market represent ownership or long-term debt claims. The various financial instruments in the capital market are explained below. 1. Equity shares. Equity shares represent ownership of a company. Equity shareholders bear the highest risk but also enjoy voting rights and higher returns in the form of dividends and capital appreciation. These shares have no fixed rate of return and are permanent capital of the company. 2. Preference shares. Preference shares carry a fixed rate of dividend and have preferential rights over equity shares in payment of dividends and repayment of capital at the time of liquidation. However, preference shareholders usually do not have voting rights. 3. Debentures. Debentures are long-term debt instruments issued by companies to raise funds. Debenture holders receive a fixed rate of interest and repayment of principal after a specified period. They do not have ownership rights in the company. 4. Bonds. Bonds are long-term securities issued by government or corporate entities. They carry a fixed or floating rate of interest and are considered relatively safe investment instruments. 5. Convertible debentures. These are debentures that can be converted into equity shares after a specified period. They combine the features of both debt and equity instruments. 6. Non-convertible debentures, NCDs. NCDs cannot be converted into equity shares. They offer a fixed rate of interest and are suitable for investors seeking stable income. 7. Government securities, GSECS. These are long-term instruments issued by the central and state governments to finance development projects. They are considered risk-free investments. 8. Mutual fund units. Mutual funds collect money from investors and invest in capital market instruments like shares and debentures. Investors receive units representing their proportionate ownership. 9. Warrants. Warrants give the holder the right to purchase equity shares at a predetermined price within a specified period. 10. Derivative instruments. Derivatives such as futures and options derive their value from underlying assets like shares or indices and are used for hedging and speculation. Conclusion. The capital market offers a wide range of financial instruments catering to different risk and return preferences of investors. These instruments help in mobilizing long-term funds and play a crucial role in economic development. Discuss the role and functions of SEBI in regulating the capital market. 10. Market. Introduction. The Securities and Exchange Board of India, SEBI, is the apex regulatory authority of the Indian capital market. It was established in 1988 and given statutory powers under the SEBI Act, 1992. The main objective of SEBI is to protect the interests of investors, promote the development of the capital market, and regulate its functioning. Role of SEBI in the capital market. SEBI plays a crucial role in ensuring that the capital market operates in a fair, transparent, and efficient manner. Its role includes safeguarding investor interests, preventing unfair trade practices, and maintaining market integrity. By regulating market intermediaries and enforcing rules, SEBI builds investor confidence and supports healthy growth of the capital market. Functions of SEBI. The functions of SEBI can be classified into the following categories. 1. Protective functions. SEBI protects investors from malpractices such as insider trading, price manipulation, and fraudulent practices. It ensures fair disclosure of information by companies and promotes investor education. 2. Regulatory functions. SEBI regulates stock exchanges, brokers, merchant bankers, mutual funds, portfolio managers, and other intermediaries. It registers and licenses market participants and lays down rules for their operations. 3. Developmental functions. SEBI promotes the development of the capital market by introducing new instruments, improving market infrastructure, and encouraging self-regulatory organizations. It also conducts training programs for intermediaries. 4. Regulation of issue of securities. SEBI frames guidelines for IPO, FPO, and rights issues to ensure transparency and investor protection. It monitors disclosures in prospectuses. 5. Control over stock exchanges. SEBI supervises the working of stock exchanges and has the power to inspect, suspend, or cancel their recognition if necessary. 6. Prevention of insider trading. SEBI strictly monitors and penalizes insider trading to ensure fairness in the market. 7. Regulation of mutual funds. SEBI formulates rules for mutual funds to protect unit holders and ensure professional management. 8. Investor grievance redressal. SEBI provides mechanisms for resolving investor complaints through platforms like Scores. Conclusion. SEBI plays a vital role in regulating and developing the Indian capital market. Through its protective, regulatory, and developmental functions, SEBI ensures investor confidence, market transparency, and orderly growth, making the capital market strong and reliable. Explain the secondary market operations and discuss the functions of stock exchanges. 10 mark. Secondary market operations. The secondary market refers to the market where existing securities such as shares, debentures, and bonds are bought and sold after their initial issue in the primary market. It does not provide fresh capital to companies but facilitates the transfer of ownership of securities among investors. The secondary market mainly operates through stock exchanges like BSE and NSE in India. The operations of the secondary market involve the following steps. Listing of securities. Companies must list their securities on a recognized stock exchange. Listing ensures transparency, liquidity, and fair trading practices. Placing of orders. Investors place buy or sell orders through registered stockbrokers. Orders can be market orders or limit orders depending on the price preference. Matching of orders. The stock exchange electronically matches buy and sell orders based on price and time priority. Execution of trade. Once orders are matched, the trade is executed at the agreed price. This happens through an online trading system. Clearing and settlement. After execution, clearing corporations determine the obligations of buyers and sellers. Settlement involves the transfer of securities and funds, usually completed on a T+1 or T+2 basis. Transfer of ownership. Securities are transferred electronically through depositories like NSDL and CDSL, ensuring safety and efficiency. Thus, secondary market operations ensure smooth trading, liquidity, and continuous valuation of securities. Functions of stock exchanges. A stock exchange is an organized market where securities are traded under regulated conditions. It performs several important functions. Provides liquidity. Stock exchanges allow investors to convert their securities into cash easily by providing a ready market. Price discovery. Prices of securities are determined by demand and supply forces, ensuring fair valuation. Ensures safety of transactions. Trading is regulated by SEBI, reducing the risk of fraud and ensuring transparency. Encourages investment. By providing liquidity and safety, stock exchanges motivate people to invest their savings in securities. Mobilization of savings. Stock exchanges help in channelizing public savings into productive investments. Facilitates capital formation. Though indirectly, active secondary markets promote primary market issues, aiding capital formation. Economic indicator. Stock market performance reflects the overall economic condition of the country. Conclusion. The secondary market plays a vital role in the financial system by providing liquidity and continuous trading of securities. Stock exchanges, as the backbone of the secondary market, ensure fair trading, price discovery, and investor protection, thereby contributing significantly to economic growth.